Good day. We will now be discussing about throughput costing under the lesson of strategic management accounting. Throughput costing is inspired by the theory of constraints, published by Robert Cox in 2002. It deals with the notion that corporations are constrained by their resources, and therefore, a constraining resource limits the capability, ergo the productivity of a corporation. Examples of resources are limitations as to materials, labor, machines, market, and even funds. Let us say the capabilities of the company are as follows in each of each resource. Then let us also figure out that the resources per unit are as follows: 2 pounds of materials per unit, 4 labor hours per unit, etc. Then we could determine the capacity of the company to produce in terms of units by dividing the capability over the resources per unit. So the company's materials can produce 60,000 units, labor can produce 50,000 units, machines can produce 200,000 units. The market can only allow a delivery of 62,000, and our money can produce 90,000 units. So the question here is, what would be the maximum capacity of the company in this particular situation? The answer is, whatever is the lowest capacity in units will be the maximum production units, which in this case is 50,000 units. Why? Because there is a bottleneck, and the bottleneck here is the 200,000 labor hours. These 200,000 labor hours, if we use 4 hours of labor per unit, we can only produce 50,000 units. So what the corporation can do in order to expand its capability and capacity would be to expand the number of labor hours available or reduce the number of resources per unit. Any of the two or both of them could expand the capability of the company to produce more. However, after exhausting all the possibilities and efforts of the company to increase the capability or manage and reduce the resource per unit, they can no longer feasibly do the same. Then the next question is, if this is already the best that we can do as far as the direct labor resource is concerned, how do we allocate our labor among the products that we produce? The answer is we optimize the use of our labor based on the throughput accounting ratio. Now, this is the new terminology here, throughput accounting ratio. And throughput accounting ratio is equal to return per bottleneck over expense per bottleneck. Return per bottleneck over expense per bottleneck. Now, how do we determine the return per bottleneck and the expense per bottleneck? Let us say we have two products. And let us say that our unit selling prices are 60 and 20 for products 1 and 2 respectively, and that they have a materials cost of 20 and 50 for 1 and 2 respectively. We get a difference between the sales price and the materials cost. That's our throughput. And sometimes we call it our return. So the return on product 1 is 40, product 2 is 150. Take note that we are segregating the materials among all the other costs and expenses. Because in throughput costing, the only product cost is the direct materials. Let me repeat. In throughput costing, the only product cost is the direct materials. In short, labor, overhead are now classified as expenses. So the total of the expenses would be determined, including the labor, the overhead, the selling, the distribution, and administrative expenses given, and then we have our profit. Now, we will compute the return per bottleneck and the expense per bottleneck. To do that, we have to know our bottleneck. Let us say that our bottleneck in minutes is 5 minutes in labor 1 and 80 minutes in labor 2. This is the number of time we need to produce each product. Therefore, the return per bottleneck is simply divide the return over the bottleneck. In product 1, we have 8. In product 2, we have 1.875. And when we compute for the expense per bottleneck, we simply divide the expense by the bottleneck. And so for product 1, we have 6, and for product 2, we have 1.5. We divide the return per bottleneck over the expense per bottleneck, we get our throughput accounting ratio. And the product to be prioritized is the product that has higher throughput accounting ratio. In this example, we prioritize product 1, and after we have exhausted the market of product 1, we start producing product 2. So this is the concept of throughput costing in strategic management accounting, that we identify the bottleneck, we try to expand our capability in the bottleneck and the capacity in that bottleneck line. And after exhausting all efforts that we can do and all resources we have, we cannot expand it anymore. And so we have to optimize the use of our bottleneck based on the throughput accounting ratio. Throughput accounting ratio is return per bottleneck over expense per bottleneck. In the next discussion, we will be illustrating the application of throughput costing. Thank you.